All right, guys, bang, bang. Darius, I thought a great thing for us to talk about today would be the debt ceiling. Everyone knows that it's coming, but no one really knows what the hell is going on. I know that at 42 Macro, you guys have done a bunch of research around this. Let's maybe just start with the money market and the debt ceiling, kind of how these two things are intersecting.
Yeah, 100%, man. So there's a lot going on. Always great to be back on your show, man. So we'll start with the debt ceiling. Right now, we have some really weird, interesting kinks in the money market curves. What I mean, money market specifically, T-bill yields. Over the last couple of weeks, we've seen the 1-month T-bill yield, which is kind of right around D-Day as it relates to when the government is likely to run out of its funds. That yield is backed up over 200 basis points in like 2 weeks. So it went from like 340 on the 1-month T-bill to about 540, and it's heading higher. And so that's clearly an indication of money market investors getting just saying, I don't want anything to do with this, because obviously if the U.S. government defaults, we're going to have quite a big issue on our hands as it relates to money market funds breaking the buck, things of that nature.
When we go back and look at 2011, I know you guys did this case study. And so one of the pieces of the current debt crisis is uncertainty. There's chaos. There's fear mongering. There's optimism. Like there's all these emotions and feelings. But at the end of the day, no one has a crystal ball. No one knows what's actually going to happen. We have to look to history for some sort of guide in these past situations. 2011, you guys did the case study. What did you find when you did that?
Yeah, man. So it's not a case study. I was trading markets back then. I definitely remember this very loud and clear. This is one of the biggest lessons that I learned in my career that's been very beneficial throughout my career, which is asset markets are the conduit from investors and the real economy to politicians down in DC, whether they be Federal Reserve officials, whether they be members of Congress or members of the White House. And so what I learned from that particular experience is that when you have an impasse or a stalemate down in DC, I like to call it kabuki theater, particularly with respect to this debt ceiling issue, because it always eventually gets extended. You almost need the crisis in the markets to bring both sides closer together at the negotiating table. Right now, Speaker McCarthy is very much dug in terms of calling for, sequestration and cuts on mandatory spending programs, et cetera. Obviously, Biden's dug in with respect to his agenda and the Democrats' unwillingness to pass the debt ceiling with any contingencies. And so it's ultimately, the closer we get to that scenario, again, Janet Yellen has outlined June 1st as that D date for a potential default. It might be a little bit longer, might be a little bit shorter. No one really knows. But the closer we get to that moment, and the less and the likelihood that we don't have a deal in place, the more likely it is asset markets start to sell off in a very material way to bring both sides closer together. Nothing focuses the mind like a hanging, right? And that's ultimately what we might see. You saw the S&P decline about 17% in like 2 weeks, going back to that late July, early August 11 experience.
Before we move on to other topics, should we be worried about the debt ceiling? And do you think that the U.S. is actually going to default?
No. No. This is kabuki theater. It's very expensive kabuki theater, depending on when and what asset you buy ahead of it. But I think you should be worried about the debt ceiling for a completely different reason, which is the U.S. government has not been issuing debt on a net basis for a couple of quarters now. And so Uncle Sam, or as I like to call the schoolyard bully, at the top of the global capital structure, really has not been draining liquidity from asset markets really for a couple of quarters as a function of this, kind of hitting the statutory debt limit. So, what we've really been seeing is just kind of constant rolling over and churning of T-bill yields. But I think what's just as important is that because there has not been much net coupon supply in recent quarters, quantitative tightening has really lost its teeth. We're not seeing the decline in bank reserves associated with quantitative tightening because we're not necessarily seeing incremental coupon debt being issued by the Treasury. That will change at some point in the next, call it 4 to 6 weeks, because regardless of whether they legislate a legitimate debt ceiling increase or they just punt it into the future, we know that Uncle Sam's going to come back to the market with some coupon issuance, which would make quantitative tightening a little bit more onerous than it has been in recent months.
So we know that the U.S. obviously does not operate in a vacuum. It is part of the global kind of economic system. Let's go to the other side of the world, China. I know that you guys have been paying a lot of attention to what's going on in China. Let's start maybe with headline CPI year over year for China and other emerging markets around the world.
Yeah, absolutely. So in this chart where we show headline CPI on the left and core CPI on the right, we're showing them on a deviation basis, on a Z-score basis relative to their trailing 10-year means. And what I wanted to call out on this China chart is that we're going to get China CPI on Thursday. This morning, overnight, we got the Chinese trade data for the month of April, and we saw import growth slow pretty sharply to down 8% on a year-over-year basis, crude oil imports crashing, et cetera. This, in our opinion, is kind of the big risk as it relates to kind of some of the broader narratives out there around globally synchronized recovery coming out of China, Asia, Europe. That's obviously kind of coming under question. And what may actually be a silver lining in this sort of, reduced Chinese demand outlook is the fact that the PBOC might actually be coming back to the market with some pretty aggressive balance sheet expansion. And so what we show on this, the next chart 4, are the balance sheets for the ECB, the Bank of England, the Bank of Japan, the PBOC, and the Swiss National Bank. And so we'll focus your attention on the BOJ and the PBOC curves, which are the black line and the red lines in that curves. Those two central banks, where you go back and you look at the bottom that we saw in global liquidity, vis-a-vis central bank liquidity, et cetera, in the latter part of 2022, those two central banks are really in charge of, or really the biggest outsized contributors to the uptick that we saw in global liquidity. If you go back and you look at this on a 3-month impulse basis, which tends to be the kind of the duration that corresponds or correlates most to asset markets, the BOJ's balance sheet peaked at plus $953 billion on a trailing 2-month impulse basis in January. That number is now minus $197 billion through April. The PBOC's balance sheet, which I think is as important as it relates to the CPI data we're going to get on Thursday, it peaked at plus 788 billion in January, and that number's all the way down to plus 88 billion in the most recent month. And so, in our opinion, we've seen kind of global liquidity stall out in the past couple of months. That's the next chart there, where we kind of show the 3 different factors in our global liquidity proxy model, whether it be the global central bank balance sheet, global narrow money supply, and global FX reserves, ex gold. All 3 of those indicators have sort of kind of like peaked in January and February and have rolled over pretty materially since. If you look at the global central bank balance sheet, it was plus 1.4 trillion on a trailing 3-month basis in January. That number is minus 254 billion in April. Global narrow money supply plus 2.2 trillion on a trailing 3-month basis in January. That number is all the way down at minus 848 billion in April. And then the global FX reserves plus 439 billion peaked in February on an impulse basis and has since slowed to plus 63 billion on a trailing 2-month basis in April. And so we're seeing kind of that tidal wave of global liquidity that's been very positive for Bitcoin, very positive for kind of, long duration assets throughout the year to date. It's very much started to wane. And so one thing that may be positive, the silver lining that's coming out of this China slowdown, or not slowdown, is just disappointment in the Chinese economy. You may actually get the PBOC back engaged in terms of expanding its balance sheet again.
How much of the central banks are mirroring each other versus some are chasing the U.S. or the U.S. is chasing other central banks? Like, how do you think about the relationship between them?
Yeah, no, phenomenal question, man. So, with respect to the English, or not the English, the European central bank balance sheets, they are very much lagging the Fed with respect to their policy. We got the ECB most recent policy decision last Thursday post the Fed. They hiked interest rates. They slowed the pace of the interest rate hikes, but they also outlined that they're going to be implementing a faster balance sheet expansion starting in July faster balance sheet contraction started in July. So they're kind of just lagging the Fed by a couple of quarters as it relates to their reaction function. Same thing with the Bank of England. We're going to get their policy update in the month and for Thursday, and they're very much kind of lagging both the ECB and the Fed. Swiss National Bank, Bank of Japan, PBOJ or PBOC are all kind of in a different boat. These balance sheets are in a very much different boat because they are sort of fighting the kind of traditional balance sheet beggar thy neighbor war, which is down dollar means our currencies go up. We're predominantly export-oriented economies, which means if I allow my currency to appreciate versus the dollar more so than you the Japanese yen, or if I'm the Japanese yen, then you Swiss franc, or if I'm the Swiss franc, you Chinese yuan, then that's going to obviously hurt the relative demand for their goods and their services. And so what tends to happen when you're in these periods of declining U.S. dollars or declining dollar values, you tend to see those kinds of central banks really start to step on the gas to kind of limit the appreciation that we're seeing in their currencies. And thus far, the Chinese authorities have been the most effective in causing, kind of a reversal in flows from their economy.
The last chart that you have here is global liquidity, S&P 500, and Bitcoin, which are obviously various types of assets across kind of the global world. What is this telling us?
Yeah, absolutely. So as I mentioned, our global liquidity proxy just amalgamates the global central bank balance sheet, global narrow money supply, and global FX reserves ex gold for obvious reasons. Global central bank balance sheet contributes to global liquidity. Global narrow money supply central banks aren't the only entities that create liquidity. Obviously, commercial banks create liquidity as well. And then you also have to look at liquidity that's being created through the growth of FX reserves, because again, that's that process of, PBOC, BOJ, et cetera, defending their currencies against, dollar devaluation. And so when you amalgamate all three of those instruments, we saw global liquidity peak at plus 3.9 trillion on a trailing 3-month basis in January. It's since rolled over to minus 1 trillion in April. So it's not as negative as it had been throughout most of 2022, but it certainly started to be negative a little bit at the margins in recent months. And the reason I call that out is not to scare anyone. It's not particularly that negative on an absolute basis. But what I will call out in that chart is if we're showing in the bottom panels each of those indicators, the global liquidity proxy, the S&P 500, and Bitcoin on a trailing 1-year Z-score basis. And what we see is the Z-score for the global liquidity proxy is somewhere right around minus 0.3 or 0.4, whereas the Z-score for the S&P and Bitcoin are right around plus 1.2, plus 1.3. And so it's telling you that assets have kind of run up faster than what is implied by global liquidity. Now that's totally fine. You can have these kind of deviations, for several months at a time, but generally speaking, they generally do trade, kind of in line with each other. And if anything, the global liquidity proxy tends to be a leading indicator for things like the S&P and Bitcoin. And so the one thing I will say is that, asset markets may have gotten over their ski tips a little bit. And in the context of this debt ceiling, which may require asset markets being the conduit to pull these guys closer together from a negotiating standpoint, and also the return of coupon issuance on the other side of this debt ceiling increase, you could be heading for a period of kind of rocky, volatile asset markets over the next, let's call it month or two.
Are you making any changes to your portfolio based on all this information?
No. So we run a very systematic portfolio construction process at 42 Macro. I have a lot of thoughts. I have a lot of views, but ultimately those thoughts and those views get filtered through our weather model system, our volatility adjusted momentum signals, in order to sort of guide the pivots that our portfolio construction is making. The one thing I would call out is that systematic process is currently at 51% cash. And so if there's a signal there, I think that's certainly one of the bigger signals in the process.
Yeah, I think that being systematic in times of uncertainty ends up being pretty good. Darius, where can we send people to find you on the internet or find out more about 42 Macro?
Absolutely, man. Thanks for joining us, and we'll catch back here next time. So we're at 42macro.com. 42 Macro Weather is our Twitter account. We also have a private Twitter for 42 Macro subscribers at 42 Macro Aware. Appreciate you for having us, man.
I always appreciate it. I always learn so much from you guys. If anyone hasn't checked out 42 Macro at this point, they must be sleeping. But thank you so much for putting together the charts.
Under a very comfortable rock.
No, I think you guys are doing a great job. So I appreciate you coming on and educating us every week or so. And we'll definitely do this again in the future.
Absolutely, brother. Catch you next time.